Good morning, traders. Happy Monday, December 3rd, 2018. Fix Trader here. I thought I'd talk about a couple of trading concepts as it's a gap up day, and this is a lot of times where traders get in trouble. Big gaps ups or gap down. Gap trading is very hard because people get very emotional. If the market's up, they're afraid of FOMO, fear of missing out. Or when market gaps down, they're trying to bottom. I would say bottom fishing and top top finding or whatever, top fishing are the quickest way to lose money for most traders. They think they hit bottom and the market keeps going lower and they keep losing money, or they think this is the top and they go short and they lose money as well as the market keeps going against them. I want to talk about a couple of concepts about trading which have helped me. One of them is Discipline Equals Freedom from Jocko Willink. It's actually a good book. I highly recommend it. And I've learned that you can have a greatest strategy in the world and indicators or whatever else, but if you're not disciplined to execute, then you're just gonna lose money, and that discipline what comes in key. Along with that is the Pareto rule. I've talked about the concept Pareto rule, where 80% of your profits come from 20% of your trading. I've over here. So a lot of times, you just want to just sit, have a plan, and sit, not do anything, not trade at all until you get the situation you're looking for. And I have my buy plan, my buy points right here, the buy points that I put in place, to help me control my FOMO, fear of missing out. To go, hey, if I want to buy up here, the market's overbought, it's above the trend, it's above the 3-day, the 5-day, and there's going to be a mean reversion, probably going to come down. It's above this green line, the 5-bar, which is my 15-minute chart here, and that could end up shorting the TVIX up here or buying the spiders, and the thing starts trending down. And that could be, my account will be in the red. I could lose money. And who knows how much. There could be a tweet or news that cause the market to reverse. One of the news that's driving the markets is actually, interest rates. And we see the bond prices here. Oh, it didn't show up. Bond prices have fallen. When bond prices fall, interest rates go up, and we'll see how the market handles higher interest rates. Where the 10-year right now is at on 3.03, 3.06, around there. We'll see how the market handles that. Market doesn't like higher bond prices. And actually I can put a chart of it here. The bond prices, the 10 years at 3.03. Last time when it starts creeping up to the 320 area, 318 area, the market didn't like that. But I want to talk about, when you trade these gaps, when the market gaps up like this, you have to have a plan. And this is my plan for the day. To cure my FOMO is to know that price action will always have mean reversion, meaning that price will come down and this line 3-day and 5-day will come up and they'll meet at some point. And so my rule is just to wait and see how the open trades. I trade small because you don't want to trade big and be down big. Trade small and see, because if you're right, you'll make some money, and if you're wrong, you're not going to lose a whole lot. But if you take a big position and start shorting TVIX, $20,000-$30,000 worth, and the thing goes down $4 or $5 on you, or if short $4 or $5 and the thing goes up in price, and you're down $2,000 or $3,000 in one day, and you've ruined your week before it's even started. So you just want to wait, and also know your time frame. The market's going to be overbought because it's going to be overextended, way above the 3-day and the 5-day. The 3-day when the market opens will be around 277.66. I did the math myself. The 5-day will be around 276.60, and it's going to open around the 281 area. So somewhere on Tuesday or Thursday, the market's closed on Wednesday for Memorial, President George Bush. It's going to probably come down and meet that line, and that means the TVIX will probably go up in price. So, know my time frame, which means I'll close all my positions at the end of the day, because the market's overextended. I keep that in mind, and that's another reason why I want to trade small. And then if I'm wrong, that I'm not going to be down a whole lot, and maybe I can, if I'm down, I'm only down on 50 to 75 shares, not 600-700 shares, So this is my plan for the day, my buy points, which controls my FOMO. If the market gaps up here, I really like to see this green bar, the 5-bar moving average, catch up to the price, and I'll short the TVIX around there. or this is the primary bar. It'd be right around here. Like I said, the market tends to come back to this first bar of the day. Somehow it touches it somewhere throughout the day. Or either short the TVIX when it's up the top of the bar, or most likely for me it'd be at the short end of the bar because it's way overextended. So somewhere when this green line, you know, this green line comes up and somewhere throughout the day it catches up, and the price action will be like here. And if the price touches the, I'll short the TVIX somewhere around the bottom. You know, and we'll see how that goes. That's my plan for the day. That's being aggressive, you know. So I have the, when the green line catches up, that's could be a buy point. That's very aggressive for me. If it's at the top of the bar, that's aggressive too, because I think it's overbought. Or at the bottom of the bar, that's aggressive too. I could do no trade at all, just sit aside, knowing that Tuesday is a better day to trade. You know, and this was a situation where sometimes I went in all cash because I don't like my trading to be determined by tweets, you know, and policy over the weekend. It's one of the things with this year has been there's so much tweets out there that causes a lot of volatility, and the market just has swings all over the place. And so it's best sometimes to just watch and not lose money than it is to try to make a little bit of money, because the upside here is limited. I mean, it's up $5.25. The spider is very likely will not go up $6, $7, $8 for the day. I mean, it could, but the probability is low. It has a high probability of coming down and maybe going higher, but it's not going to open up a $5 and go $6, $7, $8, $9 in the first 15, 20 minutes. So that's where the Pareto rule comes in. When you just wait and see what the action is going to be. It's going to be trading upward, gap and go, or trading downward, you know, or trading downward this way, gap and sell, you know. But we'll see. But that's where the Pareto rule comes in. I hope this is helpful to managing your FOMO. I hope this helps you with your trading. Thank you very much. Please like my videos and subscribe if you like the stuff I put up. Fixed Trader here signing off.